and to our first small cap, Qualitas. It's one of Tribeca Investment Partners' big ideas. Qualitas, in the simplest of terms, is an alternative real estate investment company, but it is hardly a one-trick pony with a focus on both credit and equity for institutional, wholesale, and retail investors. So, a very warm welcome to Qualitas CEO and co-founder Andrew Schwartz and Tribeca's Angus Wright. Good morning.
Good morning.
Nice to see you here,
Likewise.
both.
Good morning.
Andrew, I think I did a bit of a disservice. So $9 billion pretty much in funds under management. I think you should tell us with a little bit more detail and insight about Qualitas and what it does for investors and borrowers.
Thanks, Nadine. Qualitas is a business that got going some 16 years ago. We're a real estate investment management firm really focused on the alternative sector within real estate. We have $9 billion of funds under management. 80% of everything that we invest in is in real estate private credit, so that's a very popular area at the moment within financial markets. So we've really specialised in that area. And also about 80% of everything we do is in the residential sector. Often people ask me, what does private credit mean when you talk about real estate? And in the sector that we operate in, it's about giving large wholesale loans to commercial borrowers on development type activities. It could be against hotels or loans against shopping centres or the build to rent sector, which is also a very popular area. So we're an alternative to the banks and we're able to really provide large volumes of capital, particularly for real estate debt.
Okay, so just to flesh a little bit of that out. So an alternative to the banks, does that mean that in some way this cycle is making your services more in demand? Or is it something that's fundamental and the demand will not change?
I think it's literally all of the above. The market that we operate in is known as the addressable market, is known as the commercial real estate debt market. That's about a $440 billion market in Australia. It grows at about 4 to 8% a year. I've been talking about the size of the market for over 10 years and it's literally doubled in size over that period of time. But it's really a function of the fact that the economy is growing over long periods of time. There's more need for built forms such as real estate, and the banks, traditional financiers, have really narrowed their activities really since the GFC for reasons we can get into. And so groups like ours have really been there to fill the void of growing needs for debt capital relative to what the more traditional financiers can provide. So hence why groups like ours, particularly Qualitas, is particularly high growth.
Mm-hmm. So maybe we address the elephant in the room. Angus, give us your thoughts. Do the fundamentals change if we enter another rate cutting cycle, which we know is inevitable, which would also be reflective of a slowing economy?
Mm-hmm. Yeah, no, I think obviously the rate cycle is going to impact the business, but it has, I guess, both positive and negative impacts. On the one hand, an easing rate environment is going to probably stimulate more activity in the real estate sector. So you'll see probably increased levels of construction. It'll be a win for the equity holders in the property space, which will mean, I guess, less troubled loans potentially, and so a more healthy market environment. Ultimately, the investment products that Qualitas offer are linked to base rates, and so the return on those products is likely to come down somewhat in line with base rates, but they generate or have been able to generate relatively consistent spreads over the base rates. So I guess all yield products sort of come down in line with base rates. Anything
to add, Andrew?
Really just the fact that as interest rates were going up, real estate debt became very popular because we were seen, particularly by institutional investors who make up 80% of what we do, to be a great substitute to owning the asset. Equity values tend to go down in a rising interest rate environment. So the obvious question now people ask is, well, if interest rates are going down, isn't that bad for you because you really prospered when rates were going up? But I think Angus really answered the question, which is property values firm in a decreasing interest rate environment. Also, Nadine, as you know, the economy has been quite slow, GDP has been relatively low. So in an economy that has more stimulus into it, we would expect more volume of activity. And again, that's a good thing for our deployment side of our business.
Okay, before I get too distracted by the macro, Angus, it's been alluded to, there's been so much focus on private credit this year. I've heard it bandied about. Everyone's hanging out a shingle right now. But Qualitas is a listed opportunity in this context, right? So what's your investment thesis?
Look, it's relatively simple, Nadine. I mean, as Andrew's just outlined, Qualitas are an industry leader in what is a growth segment. Private credit, particularly real estate-backed private credit, is something that a lot of people have been moving into in the last year or two, and that's because the returns to the sector or to the asset class are relatively attractive for their risk profile. And so Qualitas is an industry leader in that space in what is a growing segment, and what that means is that they've been able to grow their committed funds under management at a very high rate. So since 2010, I think they've grown funds under management at a rate of 37% per annum, and in the last 2 or 3 years that's actually inflected higher, sort of to north of 40% per annum, and ultimately that committed funds under management is what will drive revenue for the business. And so why have they been able to grow? Well, as we already touched on, it's an attractive asset class. The returns are attractive for their relative risk profile. And then it comes down to having a very high quality investment team with a long track record, and also making the necessary investments into distribution that have allowed them to sort of, I guess, capture flows on the back of that investment performance. And Qualitas have been able to build relationships with really some of the biggest capital providers in the world, which has seen their AUM grow very strongly. So that's really, at a high level, the core of the investment thesis is this is a really high growth business in an attractive asset class. Also, look, it's founder led, and management are sort of very well incentivized, still got a lot of skin in the game, and obviously very well incentivized to keep the growth going. And I guess finally, maybe it's also very well capitalized. So currently the business has something like 40% of its market cap is backed by cash and liquid investments. So it's very well capitalized for future growth, and I guess that asset backing also provides downside protection to help us sleep at night.
Yeah, that's what we like to do, isn't it? And I can't tell you how many times I've been told to follow the fund flows, right?
Yeah.
So then, you've done very well in attracting these funds. How do you continue to do so?
I think we're literally at chapter one. You know, as I hear Angus talk about, you know, all the great growth of our firm, I do feel it's still relatively nascent. I feel in Australia, we're still educating investors on what is private credit. Why do people like us have a role that, you know, that the banks can't fulfill? Whereas if you go to places like the UK and the US, investors over there very much understand the role of private credit, where private credit providers literally make up 40 or 50% of the total market for commercial real estate debt. But in Australia, we've had such a dominance of the traditional banks, it's a relatively new concept. Most of our investors are offshore based. They really understand the rise of private credit. They've seen it in their home countries. They understand groups like ours can ultimately end up being 40 or 50% literally of the total addressable market, and hence why the largest institutions in the world are prepared to, you know, back these types of platforms. Also, it goes back to just the rising interest rate environment we had earlier, where it's just a much more compelling investment class on a risk-adjusted basis, and sophisticated investors very much understand that.
And sophisticated investors are still keen to invest in Australia, because that's what you're dealing with mostly. It's East Coast Australia, correct?
Yeah, very much so. It's a good point that we very much specialise on the East Coast. We're predominantly doing residential development. We look at high density, medium to high density development. We hang around the major CBD 10-kilometre type radius where really densified type areas. And the Australian proposition is very compelling for investors overseas for a range of reasons, but probably the most predominant reason is the fact that we have, it's hard to get new residential supply into the market for a variety of reasons. One of them is it's hard to get debt capital in order to do that, and hence one of the reasons why you're seeing very low vacancy rates, you're seeing rental rises, and so groups like ours are able to provide that type of capital. But overseas investors have seen that before, and they're very much in favour of Australia.
Mm-hmm. Angus, so we've established that Qualitas is one of the pioneers of private credit in Australia. I also have been told many, many times that companies that are still founder-led, cream of the crop. But from a listed equities markets perspective, do you think that that potential investors fully understand Qualitas?
I think the business was a little unique when it came to market, and so there were things that sort of questions that came up fairly continually, I think, in sort of discussing the business with peers. Again, first of all, people sort of didn't have a great understanding of what private credit was. Inherently, it sounds like something that has a lot of leverage in it, and so that was sort of one question that comes up, and I guess it's easy to address because there isn't any leverage in the business model anywhere. We're investing in the asset management company that itself has a significant net cash balance, and then the fund products that they market, you don't deploy any leverage at all. And investors provide capital which is lent directly into projects with no additional leverage. So yeah, leverage is often one thing that I think that comes up. I think maybe a more nuanced thing is the growth. I've spoken about the growth in committed capital, which at the end of the day is what will drive revenue. But at the headline level, profit growth since listing has trailed the growth in committed capital, and that's been because when it came to market, it had a significant Qualitas had a significant amount of performance fees in its I guess prospectus year. So in 2021, gross performance fees were sort of over 90% of profit before tax, and in the last year, in 2024, that had come down to sort of around 3% of profit before tax. So the dip in performance fees has sort of seen the overall profit growth be somewhat masking that higher level of growth. But why that's important is because the market tends to value performance fees across all funds management businesses at a lower multiple, and it's the base management fees that are more recurring that tend to be ascribed a higher multiple. And now we're at a point where Qualitas is sort of, the performance fees have been reset to a lower level. Going forward, we'd probably expect them to grow, but really we can see that with management's guidance for somewhere in the mid-30s% profit growth for 2025, we've sort of got that rebased profit level. So I think that's one thing that maybe people don't understand. Those are the two key.
What do you think the market's missed?
I think some of it is just investor education and still trying to really understand. Also, a point that Angus made earlier, which is we've got a lot of cash on our balance sheet, and so I think that when you look at the total valuation, you have to take into account that more than a third of the balance sheet is sitting in the form of cash and very liquid investments, whereas I think it's basically ignoring that particular point. And I do think part of it is just trying to understand the growth of the company. It has been very strong at 40%, and so I think that people just the more skeptics and cynics would say, can somebody continue to grow at 40%? But what they don't realise is groups in the United States that have been doing this for a long time, literally at $500 billion of private credit, talking about in the next 5 years going to $1 trillion. You've got research houses like Frequent who talk about the private credit market globally going from $3 trillion to $40 trillion. And so the numbers are very, very large, and it's much better understood in offshore markets how how much growth a group like ours can actually experience. And I think our market's in learning mode, trying to really understand this whole new industry and, why is it growing at the rate that it is around the globe.
Mm-hmm. And so when you think about any of the risks associated with private credit in general, and I know that this isn't a listed, versus unlisted conversation, but this is a liquid investment as opposed to a lot of private credit, off-market investments, correct?
Yes. I mean, so it's important, first of all, to distinguish that we're investing in the management company here, and it's a listed equity, and so as liquid as any other investments in the portfolio. I think sometimes, without thinking about it, people sort of associate private credit with a little more risk than, say, equity fund managers. And if you compare it to an equity fund manager, which people in the property space, which people will be more familiar with, it is important to recognise that private credit sits above that in the capital chain, and so is actually it's a lower risk profile. I mean, by its very nature, the equity buffer that a equity funds management house takes is the risk capital. It's like your mortgage on a bank. It's sort of safer than the equity on your bank. So I think that's something that maybe people don't always understand.
Yeah, and I did want to make the distinction because it's part of the education piece, I think, around Qualitas. And we've had a question come in from the audience, if you don't mind. This is from Julie. She says, given the current surplus of office space, particularly in the CBDs, isn't there a risk that commercial real estate activity and thus, historic growth rates slow once development and refurbs are complete? So maybe you could also just address what your exposure is to office in particular or not.
Yeah, so firstly, looking through all of our various portfolios, office would represent, it'd be a single-digit number of our total portfolio. I'd say around 7 or 8% of all of our funds under management are in office, so relatively low. I have to say office is not one of my most favoured sectors in the market because I think it's a very bifurcated market in terms of the premium end. Every city in the world is very similar, where you have a premium end versus the rest of the market. You've got headwinds such as the work from home. It's incentive structures in Australia are difficult in terms of having a true net effective rent that makes sense for asset values. So it's not one of my favoured sectors. I think we're single digit. Would we lend against it? We do. But for us, it's about what's an appropriate loan to value ratio that gives us adequate protection on all the headwinds that we think that sector is facing into.
Mm-hmm. Okay, we're almost out of time. Top two reasons why you're investing in Qualitas, please.
Yeah, well, I think I've already covered them really, but so I guess first of all would be the founder-led nature of the business. Andrew and his co-founders still retain significant equity and management control of the business. And secondly is the growth profile. This business has grown really strongly for the last 15 years and still only has a very small market share in what is a growing sector. So I think that growth trajectory should have a few years to go yet.
Yeah, and I mean 40 years in the business, if you don't mind me saying, launching this in the midst of the GFC. I mean, you must have a couple, or at least one learning that you could really sort of impart with our viewers.
Makes me feel old when you say that, but I would say probably the thing I've learnt the most over 40 years is that everything has a cycle about it, and credit is not immune from a cycle. And so it is about linking up with very experienced managers who have seen those cycles, dealt in a lot of situations, including high interest rates, low interest rates, and knowing that you're in a cycle and how one deals with the cycle. So that would be, the major lesson over 40 years.
We've just had a late question come in. I can't seem to pull it up on my screen at this moment. So maybe, this is from Keith. Apologies.
No problem.
You're being very generous with your time. Keith says, will your dividends remain unfranked, or is there a plan to pay franked dividends down the track?
So our dividends are 100% franked at the moment.
Okay.
And, I don't believe, there's no reason that I can think of as to why our franking credits are going to diminish anytime soon. So I would expect that we'd continue to have franked dividends.
We'll leave it there then. Angus, Andrew, thank you so much for coming with your
Thanks,
big
Sam.
idea.
Yeah, thank you.
Thanks very
Really
much.
appreciate it.